Joe and Greg, welcome back on BCV, gentlemen. Pleasure to have both of you.
Hi, Dan. Hi, Josh. Hi, Greg.
Joe, great to be here, fellas. Thank you very much for having us.
Gentlemen, well, yeah, we really appreciate you both giving us the opportunity to talk about this. These, as we talked just a second ago, these are some of the most difficult concepts for people to wrap their head around. Everything about bonds is just kind of in a backwards, upside down world, and everybody kind of gets confused by it. So I hope we can kind of draw out some of that confusion and kind of put it down on the base level and get it better understood by most people. I think these kinds of disagreements anyway, like we're trying to water some kind of tree of knowledge here, not continuously adding piles of, shitty affirmation bullshit on everybody. One of the things that we appreciate about the two of you guys and is this disagreement in general. Everyone wants to nod their heads and lick boots. That's not how Bitcoin was instantiated. This is something Satoshi wouldn't have been licking anyone's boots. We're looking for this descent to turn into something beneficial for everybody here. And if we see if we don't see the nut shots, they didn't happen, and a couple of logistics as well. A rage quit by any party involved here is an automatic KO, just automatic. And personal insults or harassment, that's a point to your opponent. So let's not do that, gentlemen.
We will try. I think the key word is try to stay out of the way in this one. Josh and I have loud mouths and strong opinions. We'll try to kind of hold those at bay. I think we'll chime in for two key reasons. One being, if we're way into the weeds on something, we want to bring it back to the surface, we might hop in. And then if our pea-sized brains need some clarification or summarization or education, we may ask for it just to make this somewhat relatable. We want to go as deep as you guys want to go, but we also want to have some takeaways for the average huckleberry at the end of this thing. This is how we're thinking of starting. If you guys are cool with this, why don't we're not going to go too formal here. This is just the beginning. We'll kind of say this and then we'll just let this thing run. Why don't each of you kind of intro your stance and what you think you see different from the other person, and we'll kind of go each of you maybe uninterrupted for however long you feel like you want off the bat. It can be short, it can be long, whatever, but just kind of an intro to how you see it, how you think that's different from the other person. Maybe we'll start with Joe and then go to Greg.
Sure, that's fine.
Seems fair to me.
So I'll start from the position that I want to make sure everybody's clear where I stand with Bitcoin in general, because I know Greg's been transparent about this to his credit, and I will be transparent as well. I actually checked it and did the math because it can fluctuate basically on a volatile asset, but I have upwards currently of 65% of my entire net worth in Bitcoin. Okay. Vast majority. Some would say an irresponsibly long position. I don't regret it at all. I don't have any plans to sell, and I will be buying all the way down because I am fortunate enough to be gainfully employed. But I talk about bonds, and I know Greg does as well, and I talk about the dollar, and I talk about this for a very fundamental reason. It's not because I'm a bull on these assets. I do believe in the short term they provide some good optionality for trades. None of what I say is any investment advice, just as I'm sure Greg would say as well. Everybody do your own research. Don't follow in footsteps that anybody on the internet tells you on how to invest. But I do believe that the dollar and bonds in general look very attractive here, and we can go into reasons why. And I'm not a bull on these assets because I think of being a bull implies that you're somehow optimistic long term on these things, and you think that these are valuable things moving on a moving forward basis. That's not my view at all. My position comes from a very simple recognition, and it's a recognition that currently and for the foreseeable future, the dollar will remain the global reserve currency. I think many in Bitcoin have accepted that. I also believe the treasury market for the foreseeable future will remain the global reserve asset. It is the backbone of all financial activity. It is the most important market in the world, and there is nothing foreseeable on the horizon anywhere in the short or intermediate term that's going to change that dynamic. I don't know if Greg agrees with that. I don't know where he stands. There's been, comments out there that have been put out that make me question whether he does. But what I want to hear, from an education standpoint, I want people to get is that the treasury market is essential for global economic activity. It's essential for our mortgages. It's essential for manufacturing, for tech companies, for clients I speak with on a regular basis who are following these markets very closely, for cost of capital, even for Bitcoin's price appreciation, because right now Bitcoin trades like a long duration asset. It is a short vol asset. That's how the market treats it. I think the market's dead wrong, and I think we'll eventually learn that. But I'm not going to ignore the writing on the wall right now that the entire global system requires a well-functioned, well-oiled treasury market. It's predicated on treasuries. It's the coin of our realm, whatever you want to call it, the mother asset. So when I hear doom and gloomers out there tell you that treasuries are fiat contracts and that they're going to zero and the dollar's going to zero, my response is, if that's true, then everything else is going to zero too. Then it's the end of times, literally. And that's the problem I have. You go onto these Bitcoin spaces, and again, to Greg's credit, I'll pay him a compliment. He said something on Spaces, I think it was today or yesterday, that Bitcoin's not ready. It's not ready because the world's not ready to embrace it as an asset. And I think that's the correct view. Bitcoin is far, far and away being ready to fill the demand that the world needs it to do. And I think we're both optimistic long term, but we disagree on the time frame. You get these people in these rooms who focus on the fact that the Fed has, quote unquote, printed more money than any other country, save maybe Japan, over the last 10 years. And what do you have? You have record demand for treasury, particularly by foreigners, and you have record demand for the dollar globally. So clearly, there's something that people have yet to get when it comes to the dollar and treasuries globally and the importance of the role they play. They play a critical role in our system, and you can't focus on the treasury market like an individual investor does. That's wrong, because treasury markets have utility in our system. As Greg knows, and I think as both you, Dan and Josh know, they effectively provide financial lubrication. They are the collateral of last resort. They're not something that people... They are the insurance, effectively. I know Greg likes to talk about Bitcoin insurance. Actually, in our system, when the proverbial, shit hits the fan, so to speak, they rely on their treasuries to defend their currencies. And we're seeing this all across the globe right now. Because of the global dollar shortage, many countries are having to sell their treasuries in a very liquid, deep, sophisticated market to offset the pressures from raging CPI, international geopolitical threats, and everything else. They're the insurance policy. That's why even in a dynamic where you've got, quote unquote, printing en masse from the Fed, which, we can get into QE and why that's not really money printing, but put that aside, even in that dynamic, you still have record purchases, and you can call up some charts in a little bit, from foreigners to buy these devices because they have a utility premium. This is why the 4-week treasury bill is yielding lower than reverse repo right now. It's because these instruments have value. So, I really think it's important for Bitcoiners, and I'll just wrap up with this because I've been going for a while. It's really important for Bitcoiners to get the narratives correct, okay? And I was very upset last year when, and I'm not going to name names because that's not the point of this, but there were people out there, not Greg, but other people that were saying, Bitcoin's your protection against raging CPI. And then when CPI takes off, people are disappointed. And it sets a false expectation. And then when people go out there and say, many publicly, you guys can go through names, public, huge Twitter accounts with 100,000 followers were saying, corporations are coming in to pump your bags and buy Bitcoin, when there's absolutely no evidence of that, other than a few eccentric billionaires that want to buy it and add it to their balance sheet. Those false expectations and narratives, I think, confuse people. And the biggest disagreement, and perhaps the only respectful disagreement I have with Greg, and I admire him for a lot of reasons, is this comparison of Bitcoin to insurance. He put out this tweet yesterday about how, 5-year CDS swaps are 29 basis points, and that's going to effectively, that's a price of insurance on U.S. default. And he does the calculation. He basically says the intrinsic value, I think, is $114,000 based on this. We can get into it, but I think there's so many assumptions with that are just completely flawed. Number one, that the U.S. even can default. Number two, that in a global economic crisis, when, again, the shit is hitting the fan, people are going to rush into an asset that they don't even fully understand and the market doesn't get at this point. And number three, that Bitcoin's going to benefit from global economic collapse. I think that's wrong. Bitcoin is going to benefit from us continuing to kick the can down the road and debase the system. So, my view, just in summary, is debt and demographics are destiny. They will drive us towards more monetization of our debt. They will drive central banks and policymakers and everyone across the world to do whatever they can to kick the can down the road. There will be a reversion to the mean when it comes to deflationary dynamics in our society, and Bitcoin will be the biggest beneficiary of all of that. You want this system to keep chugging along because you want the soft landing. You want the situation where we can slowly, gradually onboard millions, if not billions of people onto the Bitcoin network, and the old system dies not with a bang, but with a whimper. That's my hopeful vision of Bitcoin's future, and I'm interested to see where Greg disagrees.
Amen.
Yeah.
Well
Thanks
said,
for outlining
Greg.
that.
Over to you.
Yeah. All right. So respectfully, Joe, thank you for a great introduction. And I want to follow it up with a compliment to you and your professionalism in the Bitcoin space. There are people out there certainly that they don't understand. They don't stay in their lane. They don't understand they don't know what they don't know at the end of the day. So let's start with where I think we might have had a disagreement, because the reality is the bond market is much more balanced right now in its asymmetry, in my opinion, than it was when I first came to this space and got a little bit of recognition because I published this paper on Bitcoin as portfolio insurance on a fixed income portfolio. Okay. Credit insurance on a fixed income portfolio. As most people know, perhaps they don't. I spent my entire career in credit. So I always come at a problem by looking at the credit markets first. I will also say I have no axe to grind in the bond market right now. I made my trade short bonds apparent when the TLT is a benchmark. The TLT was above 150. And I did cover my short when the TLT hit 112. The TLT has recently traded down to 101-ish, 102. And let's not get caught up in the numbers. If I had to make a bet right now, which I don't have to do anything because I'm not managing anybody's money except my own, I would probably lean slightly bullish on bonds as a trade. And this is where I need to really get granular with the audience, okay? So what is a bond? A bond, now respect to Joe, is a contract. I think we would all agree with that, Joe. It's a contract where you are paid a coupon over a period of time. And the maturity of that coupon of that contract is the length of the bond maturity, and the bond is paid semi-annually. And there is no subjectivity to it. If things are going well, it's not like they increase the coupon to distribute the wealth to the bondholders. In the event that there's a subordinate claim in an equity position, obviously those claims accrue to the equity holder in the capital structure of a corporation, for example. But for a bond, people need to understand that over the life of a bond, let's take the 10-year bond, which I agree with Joe, is the most important instrument in the world. All capital markets prices are set off the U.S. Treasury 10-year yield. You start with that yield as a base. Whether you are a foreign government, whether you are a corporation, whether you're an investment grade versus high yield corporation, you start with a cost of funds or an assumption of a base level of return to a quintessential risk-free borrower. Now, I happen to agree that, or perhaps disagree with Joe, there is a small component of default risk within the U.S. Treasury. And I'm not the only one that believes that, because if I was the only one that believed that, CDS on the United States, credit default swap insurance on the U.S. would trade for zero, but it doesn't. It trades for a premium that reflects people's desire to insure themselves against a potential, however minuscule, potential default of the USA. And I'll say that when people say, how could they possibly default, Foss, if they can print their own money? And the reality is that CDS spread is a combination of default risk as well as the potential that people don't take your printed money anymore. In the case of Venezuela, they shoveled the money to the curb. You saw pictures of that. The USA will be the last fiat to fail, and it's not going to happen tomorrow, and it probably won't happen in the next 20 years. Okay? I need to be clear about that. The problem is there'll be 180 other countries in the world, fiat countries, that will fail. Canada will fail 10 years, in my opinion, before the USA does. And when that happens, there is a contagion effect that rolls over into its biggest trading partner. Canada and the US share the biggest trading relationship in the world. Do you think if Canada defaults, that won't have an impact on US finances? I can guarantee you it will. And that's why in credit, contagion is such a large concern. But going back to the contract, how are prices set? They are set by buyers and sellers. And Joe, I think that this is where we might have a little bit of a disagreement. But before we go there, understand what that yield, let's take the US 10-year yield, which today, I just looked, US 10-year 363, 3.63% annualized or semi-annual return equivalent. It did just hit 4% when the gilt market, the 30-year gilt market in Britain hit 5%. So there's a correlation between those two markets, and the correlation traders who were getting steamrolled in gilts were shorting US treasuries as protection, driving the yield higher as they drove the bond price lower. Anyway, stick with me here, people. 3.63%. If you were to buy that US 10-year treasury, absent of a default over the next 10 years, the maximum return you can expect is 3.63%. It's a contract. Now, you can say I'm the world's greatest trader, and I'm going to buy the bonds, and when they go up in price, I'm going to sell them. Then I'm going to re-enter the market when the price drops again, and I'm going to play this game. And I'm going to tell you, you're a liar. You cannot do that consistently, because if you could, accounts would outperform their benchmark over time, called actively managed bond accounts. They don't. Look at the numbers. And why is that? Because it's a market, and you can't outperform the market. The return of the market is all the players. So on average, what they do is they pay transaction fees and a management fee, and you lose that return. The point is, Joe, I think both of us would agree, neither of us would be in a trade on the US 10-year for the next 10 years at 3.63%. Is that fair?
That's completely accurate.
There we go. So this is where we might be disagreeing on a trade versus an investment philosophy. So when I started this and I wrote this paper, and Joe, I don't know if you've read it, but this is the paper, 40-page paper, and I'm not trying to say that it's got to be read because it's got a lot of stuff in it. It's just my history. I published it 20 months ago when US 10-year yields were 1.5%-ish. Okay. High yield bonds were yielding under 4%. And I basically said, I love Bitcoin. And if you are going to take an allocation out of a balanced portfolio, please take it out of your bond position, because I view bonds as being asymmetric return opportunities to the downside. There were negative yielding bonds in the world. Going back to what that yield rewards you for to begin with, the 3.63% rewards you for inflation expectations, a minuscule part of credit risk, but it's not zero, and liquidity risk. Nothing else. That's what you have to be rewarded for in the US Treasury market over 10 years. Now, what happens if you advance money at 100 cents on the dollar at a 3.63 coupon and you keep it for 10 years? After 10 years, you will get your money back with all high likelihood, not certain, but very high likelihood. And that money you get back has been debased. That is my biggest concern with a hold period on a fixed income instrument where the currency needs to be debased because of the debt spiral. And today's a very substantial day. I don't know if you guys saw that the USA passed 31 trillion as their funded debt obligations in the world right now. 31 trillion. That's over $100,000 per US citizen funded debt. The unfunded debt, which is Medicare and Medicaid, this is the scary part, is 170 trillion incremental dollars. It's another $500,000 per US citizen. The point is simple. The mathematics do not support anything else but money printing to satisfy this debt spiral. So regardless of whether you think you can make 3.63% over the next 10 years, my argument is the debasement of the currency over that period of time will be so severe that you will have a negative realized return. No argument over whether it should be a trade. Again, if I had to trade this, I would be slightly biased to the long side, meaning I'm not shorting it here. I shorted it at 1.5%. It's now 3.63%, and it tapped out or topped out at 4. Ray Dalio thinks it goes to 4.5 to 5%. Ray Dalio, congratulations on your retirement, sir. He made 30% this year, boys. He's up 30% in a down market. How does he do that? He shorts instruments like bonds when they are negative yielding, and he levers those shorts. So Ray Dalio knows how to manage the fiat system. Problem is, most investors, small investors, mom and pop investors, do not know how to do this. And this is why we always have to differentiate between a shorter term trade viewpoint, next 12 months, maybe half year, 12 months, but 10 years, I am not a buyer of US treasuries for 10 years for the very solid reason, according to JP Morgan, well, you saw it was a JP Morgan report. I was going to reference Urian Timmer at Fidelity. Both of those analysts believe there is a very large supply concern coming with treasuries. They don't know where to find the buyers, Joe. So I'm sure you're going to show me charts of where you see other people buying U.S. treasuries, but the mathematics of when Japan is selling the treasuries because they're trying to defend their yen, and then Russia is selling theirs because, well, they got their accounts frozen. This is where the concern is, how do you fund this debt spiral on a sustainable basis? So I guess when we start all these arguments and discussions, let's say that, when we start the discussions, let's make sure we lay out a time frame on this discussion, because most of mom and pop investors will not have a time frame that's sensitive to changing information like you and I perhaps have. And this is where the big difference comes in arguments. Let's define, if we're going to talk about a pivot, how do we define what we call a pivot versus what other people think is a pivot? And then finally, I'm going to sum it up. I don't own as much Bitcoin as you. Congrats on your conviction. I own probably 1/2 as much Bitcoin as you do. And I think that's just fine for someone like me in terms of my asymmetric return profile to the upside versus the volatility of an asset that shakes people out. I mean, it shook a good friend of both of ours out of the market, and he was public about that shakeout. And I'll call him Bitcoin Tina, but some other people will, say, hey, I got shook out of the market. In terms of my net worth?
Yeah, if you don't want to share, that's fine.
Yeah,
no, I'm just saying.
Fine. I own 3 properties. I own a property in Canada. I own 2 properties in the U.S. I owned a second property in Canada in a ski community called Whistler that I just sold. And I manage that as a hard asset. I have gold. I have silver. I obviously have stocks. I have zero exposure to bonds for the first time in my career. I have zero exposure to bonds. And I'm a partner in a power company that sells power to Bitcoin off-takers. So there's call it a derivative exposure to Bitcoin in that component there. Okay. Yeah. So look, I have a portfolio that's not reflected by most people in the world. Why? Have I done okay in life in terms of being able to accumulate these assets? Absolutely. I'm lucky. I got lucky with the fiat system. But my goal now, as much as anything, is to accumulate a portion of my Bitcoin for my children. I have no desire to see the world collapse in the next 10 years. I mean, that would be a foolhardy thing for anybody to wish that this system collapses. We are nowhere near ready. Nobody's ready for a full-fledged Armageddon. I believe that would lead to social unrest and most likely World War III. I don't want any of that shit, okay? I want Bitcoin for my children and we have an issue on insurance. I'd like to talk to you about that, but that's fine. It's a model. My model is the way I like to look at things. I don't have to have other people believe in it or not. It's how I get comfort in terms of, again, I've come through the credit default swap markets. I traded them through the great financial crisis. They were a blessing and they were also a horror, okay? CDS is just another instrument to allow people to blow up. And you got to be careful with these instruments that are out there. But finally, most important, let's look at the true budget of the United States if it was a standalone borrower in the world, which it ultimately will be, and look at those dynamics and those credit metrics and say, there are some concerns over that. And whether that credit risk component of the total yield, even though the credit risk component is minuscule right now, what if that starts growing and inflation expectations are not the most important thing? It becomes credit risk. I've seen it happen many times. Everyone shakes it off. Oh, how could this AAA company possibly, let's take General Electric as an example. How could General Electric ever be credit risk? Well, guess where General Electric right now? BBB rated security, from AAA down to BBB, on the cusp of being high yield debt. These things change, and it's reflected in markets called credit default swaps or credit spreads over cash paying bonds. Be careful, people. My goal is to find asymmetric trades that are biased to the upside, not biased to the downside. And just going back 20 months, bonds were the most ridiculous investment opportunity I had ever seen, to the point where UK pension plans were levering the 1.25% on their 30-year bonds 3 times to turn that 1.25% hopefully into 3.75%. Guess what? That bond is down over 50% this year. So you lost 50% on a position that was levered 3 times. That's why they had to come in and rescue the pension plans in the UK. That is a disaster when you bring leverage into an equation like that. So thank you for, understanding my position. I'd like to discuss the various issues why you don't think that Bitcoin is is insurance, but that's all good. The bigger picture here is we're aligned on a investment exposure that will benefit in, I think, all likely outcomes. In other words, I think all paths lead to Bitcoin, regardless of whether your viewpoint on US 10 years in the short term is correct or whether my view is correct. The mathematics lead to Bitcoin. Be a good risk manager. When the information changes, well, maybe we'll have to change our position accordingly, right? But for now, I am not changing my exposure. My exposure was as high as 50% at one point. Why? Well, because Bitcoin has come down from the all-time highs. I'm sure yours was much higher too, Joe, unless you've just been adding a whole lot at the bottom, which I'm fine with too. I got into Bitcoin in 2016 when it was under $1,000. So I rode that position up. Did I sell some? 100% I sold some. It's my business. I manage risk that way. I don't ever want to be in a position where I have no dry powder to buy something, or the flip side being, damn, I was telling everybody to buy it at 70,000 and then I didn't, I believed my own bullshit. We're not smarter than the market. I'm not saying people should trade Bitcoin daily or anything like that. But if it gets to be too big a position in your portfolio where you're not sleeping properly at night, I think that's speaking to yourself. It's telling you
So
you can't handle that exposure.
Let's take a quick break and hear from our show sponsors. The BCB podcast is sponsored by Capital Logistics. Capital Logistics is a freight broker connecting truck drivers and shipping partners around North America. A true blue-collar business that supports blue-collar Bitcoin. They specialize in temperature-controlled cargo, efficiently hauling food, supplies, and other freight nationwide for some of America's largest companies. Capital Logistics is a firm believer that people and businesses should be able to save what they earn without having their purchasing power manipulated by the financial system, ravaged by inflation and currency debasement. As early adopters of innovative systems throughout their business, Capital's excess cash flow is put into Bitcoin every month. If you're someone that wants to work with a company that shares blue-collar values and an affinity for Bitcoin, reach out to Capital Logistics today. Find them online at capitallogisticsllc.com. That's capitallogisticsllc.com.
What if you didn't have to pay healthcare premiums anymore? What if you could invest in Bitcoin instead? With CrowdHealth, you can put aside money for health expenses in your own account and even hold a large part of it in Bitcoin. If Bitcoin goes up, you get the upside, not big insurance companies. Pay one low monthly total to fund your account that is yours. Choose your doctors and hold up to 75% of the funds in Bitcoin. If a large expense comes up, CrowdHealth will crowdfund the bill for you to pay quickly. Stop supporting the broken health insurance system with your hard-earned capital. Go to joincrowdhealth.com and use code BLUE now and experience freedom from health insurance by utilizing Bitcoin. Right now, you can get your first 6 months for just $99 per month. That's a fraction of high-deductible insurance plans. Go to joincrowdhealth.com and use code BLUE to sign up. That's joincrowdhealth.com, promo code BLUE. CrowdHealth is not insurance. It's a totally different way of paying for healthcare. Terms and conditions apply.
BCB podcast is sponsored by Ledden. Ledden is a very unique financial services company with a highly principled, Bitcoin forward perspective. They are the first ever digital asset lending platform to undergo a formal proof of reserves attestation, where an independent public accountant regularly confirms that the company is properly accounting for client assets. Simply put, this company mirrors and embraces the transparency, accountability, and auditability of the Bitcoin protocol and network itself. If you've listened to BCB, you certainly noticed that we advise our listeners to be careful, manage risk, and never get over-leveraged. And that does include ensuring that any borrowing and lending decisions make sound mathematical sense based on your lifestyle and specific situation. Where available in your jurisdiction, Ledden offers a menu of powerful financial services. Keep ownership of your Bitcoin and access dollar loans with Ledden Bitcoin-backed loans. Harness your Bitcoin holdings to buy a new property or finance the home you already own with the upcoming Ledden Bitcoin mortgage product. Save Bitcoin and USDC to have access to Ledden dollar loans in their trading service if available. You can look into Ledden's well-architected menu of services at ledden.io, that's LEDN.io, and visit start.ledden.io/blue-collar-Bitcoin and sign up to get $10 USDC for creating and funding an account.
Blue Collar Bitcoin podcast is brought to you by arguably the most legendary company in Bitcoin, CoinKite. Established block 141,000, CoinKite is an industry leader in security and signing devices. They are also the producers of the renowned Cold Card, the world's most trusted and secure Bitcoin signing device. Built with a plethora of features fit for Bitcoin beginners all the way up to the most advanced users. This device is a one-stop shop for your Bitcoin custody needs. CoinKite also manufactures the Block Clock, a gorgeous e-ink digital art piece sitting in the background of every serious Bitcoiner on planet Earth. Block Clock can be programmed to scroll through key Bitcoin metrics including price, hash rate, next halving date, and much more. They are also the makers of the Open Dime, a small USB stick that allows you to spend Bitcoin like a dollar bill. Pass it along multiple times. Check out CoinKite's whole suite of products, including the Sats card, tap signer, seed plate, and that honey badger hat you know you've always wanted at coinkite.com. Use promo code BCB for 5% off select purchases, including the Cold Card, at coinkite.com.
Now back to the show. Yeah,
So
Joe,
Greg,
unleash here.
Yeah, I didn't want to interrupt, but there's just a lot of good talk, little nuggets I want to go over. Okay, let's go back for a second, okay? And I think we may be in agreement on this, that the signs are all over the place. We could be headed for an economic hurricane. You see growth rates slowing, contrary to people that were saying we're in a recession this year, we're not. the data's consistently remained at least mild. I would say there hasn't been an economic collapse this year, contrary to people calling that all the entire year. You had GDI that was positive every single quarter so far this year. You had nominal GDP through the roof. On a real basis, it's slightly negative in Q1 and Q2, and you have a print coming for Q3 if GDP now cast is to be trusted on Atlanta Fed for 2.3%, which is bigger than most of the GDP growth during the Obama years. So we're not in a recession currently, but we could be headed for one. And let's go back to what Greg says, and I think this is important for investors. And again, none of this is financial advice, but I think it's important to look at asset classes. In an economic hurricane, in a deleveraging event, in a deflationary spiral, whatever you want to call it, where there's contagion and systemic risk, and Greg's talking about credit risk and GE, and you have companies going under. Where does money go? In our system, when money is scared, where does it hide? And the answer is the treasury market. And you can go look at the last several crises we have. Look at the COVID crisis, which Greg referenced. COVID 10-year treasury bottomed out at what, 0.4, 0.3% on a 10-year treasury? Why was that? Because the entire system is designed to pile into these assets when, again, the proverbial shit hits the fan. That's the way it's constituted. Same thing within the great financial crisis. You saw people hiding out in bonds. Why do they do that? Why do they go into bonds if there is some credit risk? Because we know that in our system, if there's one thing we can count on, which again, I agree with Greg, it's not 100% certain. Nothing is in managing risk. But if there's the lowest risk spectrum, it's that the United States government is going to do what it takes to backstop the system. That is, they're going to do what it takes to reliquify the treasury market. So if you're talking about a trade in the short term, and you're in this environment, and Greg, I'll share I have exposure to stocks, I have real estate, I have my Bitcoin position, and I have my bond position, which I purchased and put on with options, which to me, that is the quintessential insurance and protection for your portfolio. It's a small position. It's fewer than 4% of mine. And if I'm right, and the system does have a deflationary spiral, it's going to pay off. It's going to be a huge asymmetric return the way I put the position on with 2024 call options. I'm down on them 10% last time I checked because I've averaged into the position. But the point being, and again, no one's supposed to follow me in this trade. That's not the point. The point is that if you see storm clouds on the horizon and you say, my entire net worth is in, say, real estate, stocks, and Bitcoin, there's only two ways to really protect against deflationary spiral. It's cash, which, it's fine. I think people holding higher levels of cash, that's, perfectly legitimate given the economic conditions we're in and the uncertainty on the horizon. That's a good way to offset risk. And the other way to mitigate it is bonds and bills. If you're in bonds and bills, you're going to have that dry powder that Greg was just talking about to effectively buy the dip on these assets. And by the way, in a deleveraging event like we're talking about, it's not just going to be Bitcoin. It's going to be everything. This is why you've seen gold. I mean, it's kind of amazing. People think gold's a safe haven asset, and Greg and I may disagree on gold. I think gold is tied up in this liquidity environment like everything else, like Bitcoin, like stocks. They're all dependent on free flow of capital. And when you see a rush to safety, when you see a rush to the dollar, as evidenced by the spike in DXY, what happens? When the DXY spikes, stocks sell off, gold sells off, Bitcoin sells off, even bonds sell off, right? Because the world's short dollars. And that's the dynamics of our system. And by the way, you see the bonds selling off the way it did, not merely because the Fed is hiking. That's wrong, because there's been plenty of times in history. You can go back to 2017, you can go back to 2004. The Fed is hiking aggressively and the dollar is falling alongside that. The dollar is effectively responding to geopolitical risk in a mad scramble for dollars globally. That's the key thing. Whenever there's geopolitical risk, whenever there's inflation, it hurts emerging markets tenfold what it's hurt in the United States, because not only are they hit by the price pressures, but they're hit by the currency risk. And this was happening in Britain as well. They're already in a recession. Okay, UK is in a recession right now, and I don't know if you guys saw the last podcast today. I think you commented on it, but this professor Wei Zindu of Chicago Booth, she broke down the data and showed through her econometric models that the majority of the sell-off in the gilt market was driven by the Great British Pound USD currency pair. That's what was driving it. They were trying to offset those, and Greg's right. They're using the treasury market to try to hedge. That's the whole point. The treasury market is a hedge for uncertain environments geopolitically, for uncertain environments economically. And right now, if you do believe we are trending towards deflation, we're trending towards a recession, you should expect bonds to do well. And it sounds like Greg, if he had a gun to his head, he would say the same thing. And again, when I say bonds, I don't mean corporate bonds. I'm speaking specifically about the treasury market, because again, that is your true insurance policy in this dynamic. And now, is it possible that you could have a global recession and everything can go to hell and there won't be any effort to bail out the treasury market? I don't think so. I think any way you cut it, if there's one market that, and I see Greg wants to get in here, but if there's one market that will keep the Fed up at night and will, cause them to consider reevaluating their policy or doing something to liquefy it, it's the treasury market. They cannot stand the treasury market to break. It is the market of last resort. And just look at the data. These bigger institutions, these bigger pensions funds, bigger foreign sovereigns, they need a market where they can liquefy hundreds of millions of dollars, if not billions of dollars, in a short amount of time. Do you think you can do that with Bitcoin right now? Go look at what Saylor said about having to buy, a Bitcoin, how difficult it is in a short duration to get Bitcoin off of exchanges or buy it from an OTC desk. You can't put on those big positions with Bitcoin yet. It's just too small. We're years away from that.
Yeah.
So anyway, I'm sorry, Greg. I saw you wanted to go, but
if I could just jump in, one question real quick, Greg. I'm sorry, I'll cut you off. I just want to ask Joe one really quick question about his idea there. So it sounds to me so you said this options position is about roughly 4% of your portfolio. So the way you're positioning this is almost your view of portfolio insurance for yourself.
Correct.
Against having these ultra aggressive situations, like 65% Bitcoin, obviously that's extremely volatile. You're watching your net worth up and down all the time.
Collapse.
Right. Yeah. So
more than 7 figures down. Okay. It's not fun.
I feel you, man. Believe me.
I mean, listen, I'm not anti-Bitcoin. I'm not. I'm the biggest Bitcoin bull you'll find.
But I think it's really important for everyone to listen and everyone understand that this position is what Joe is viewing as insurance for his overall portfolio. And when you characterize it that way, Joe, it makes a lot of sense to me. And I hope people are following to understand that. He's basically levering this small position size so that if there was, economic shitstorm, this would very likely increase in value substantially, thereby protecting your downside risk in Bitcoin and all these other.
And if I'm wrong, and Bitcoin skyrockets and goes to 100K from here and sovereigns default, guess what? I'm going to be sitting pretty either way, right? I mean, I'm going to be fine.
Greg, before you go, I want to pull up one of your tweets, Joe, because I think it's a good summary for some of what you've described. 1 second here. If you're watching us on YouTube, you can see this. You guys see that? Yeah. So tell me I'm assuming you still resonate with this. This is recent. 2 paths. This is your tweet. Cut rates, QE, monetization, fiscal stimulus to avoid recession, all of which bring yields down sharply. Option 2, keep rates higher, crash asset prices, now we're in the recession realm, trigger liquidity crisis, and eventually cause a depression, which also brings UST yields down sharply. You choose.
Yeah.
You want to elaborate on that just a touch?
Yeah. I mean, I think that either way you move forward, these rates are not sustainable. And I think Greg agrees with that. I mean, the debt levels are not sustainable for the long term. You can't have, in my mind, and if you don't trust me, look at Stanley Druckenmiller. He's saying a 10-year above 4% consistently for any long period of time makes the finances of the U.S. government not sustainable. And that's his quote, not mine. You are at levels here where I think you can call them peak hawkishness, right? You can yields go higher? Absolutely. I didn't think they would go this high, to be honest. I think if you would have polled people last year and said, we're going to be doing 75 bips, 75 bips, 75 bip hike, and the system isn't going to collapse, they would have said, you're crazy. It'll fall apart within weeks. And I heard that consistently over. So who's buying this? Who's buying this paper? Who's holding it together? Why aren't you seeing massive unemployment? Why aren't you seeing credit crises? I mean, you've got, some spreads that have blown out and become, I mean, they're stressed. There's no doubt, right? They're stressed. And no one's going to dispute that. But I mean, I sent over, pull up the St. Louis Fed Financial Stress Index, pull up the Chicago Fed Financial Conditions. You have all those charts. Look at those. The St. Louis Fed Financial Stress Index shows record low stress in the financial system. What is it? Just dumb? The model's just broken? I mean, maybe it's possible, but I mean, we're looking off the best available data, and I don't think you're seeing this sort of economic collapse that people are talking about. Maybe we'll get it eventually, but I think it was in the attachments I sent you.
Yeah, I'm trying to find which one it is.
Anyway, Greg wanted to go, so we won't waste time.
Well, no, this is good. This is good. Gentlemen, look, there's two things I'd like to say. Firstly, I follow this a report called the Bear Traps Report. It's put together by some credit guys, Larry McDonald. But anyway, he also has a stress indicator, 21 indicators of financial stress. He calls it his Lehman Index. He sees the markets differently. He sees it as the highest levels of stress since the depths of the COVID crisis. There's obviously different metrics or components of that stress level. But I think what I'd like to go back or just take, Joe, I agreed with everything until you say global depression and then rates go lower. How do they go lower when people are therefore concerned about being appropriately rewarded for a risk they are taking for a credit event? You can't say that we can go into a global depression and not understand that the credit metrics of the US, which are already horrible, wouldn't get meaningfully worse. And therefore, people would avoid focusing on the inflation remuneration from the credit or the yield rather,
Greg,
and switch that into a credit concern.
Greg, in a hard downturn, you know as well as I do, you're not going to be concerned about inflation. It's not going to be an issue, and there's never been a deflation.
Well, I just said that, but it's credit though. It's credit, and when you respectfully, when you look back at other ones though, there was not the same level of credit stress in the USA. The COVID crisis itself pushed the U.S. over the limit where it is now mathematically impossible to skate the budget deficit on side. I've sent some stuff to the fellas. I don't even want you to put it up, guys, but this is from the Congressional Budget Office themselves. This is from the internal offices of the United States that show a deficit funding that is basically unsustainable. It's so crazy that they even publish this. And people say, okay, that's fine. Well, we'll just keep printing money to fund the debt. That's okay. It just means that your debt component, your error term of the debt spiral is a debasing currency. And the US dollar, yes, it is the best horse at the glue factory. I mean, that is absolutely 100%. But it doesn't mean that you have to own that. You get positive returns on your bonds, but you get negative returns on your debasing of the currency. And that's the biggest thing I have. Thank you for putting that up. This is the Congressional Budget Office of the deficit of the USA out through the years.
2051, I think. It goes.
What assumption for rates?
Okay.
What assumption for rates are you using on the chart?
It's not me, it's the CBO, and the rates are lower than they currently are right now. They were growing at about, a 2% interest rate. If you get to 4%, that compounding that Stanley Druckenmiller just points out makes this deficit so much. So the primary deficit, let's go through that. The primary deficit is entitlement and it is military spending. The blue, which is the net interest, is the growth of the deficit because of the increased coupons on your expanding debt spiral.
Right. So who's going to buy that? Who will buy that? Who buys that?
The Fed.
Let's explore this
Fed.
topic.
Only the Fed. There's not enough money in the world for all the other central banks to buy it. So the Fed buys it. It's called QE infinity. And when you have QE infinity, you have rapidly debasing U.S. money. Fiat, though. Does the DXY still go up in value? Yeah, probably. You know why? Because all the other countries are even worse shape. And that's the problem. We're comparing a debasing currency, a melting ice cube, US dollar fiat, with other melting ice cubes. And the US dollar just happens to be melting slower. So this is why I have concern with people who look at the return in the bonds, but forget the debasement of the currency. This is why I can't tell you anything except what the Congressional Budget Office just put out for a 30-year bond. I would not own a 30-year bond. I said that the 10-year bond was 363. The 30-year bond, U.S. Treasury right now is 369. Man, I don't know. I know Raoul Paul and those guys were bullish on bonds, and he even had a T-shirt made up and everything, and it went in his face. I have one more thing to say, though. I like your position putting it on in options. The problem that I see with putting it in options, what is the implied volatility on your option? Have you checked that? What the option market is charging you as an implied volatility?
I bought a whole sequence of these things, so I can pull them up if you want.
But
if you really
right
want to get into
now,
the
here's the craziest thing. Treasury volatility is higher than equity volatility. You're paying a lot for that option. That time value of that option.
You know
is
why? It's higher because
volatility.
you've had the fastest hiking cycle in history. It's higher because you have 75 bips after 75.
But it's still expensive. So can I compliment you on doing it through options? I need people to understand, though, that the time decay in that option is substantial because of the vol. Yeah. And when the equity vol is lower than the move, what's called the MOVE, the treasury vol, boy, these options positions, they are expensive. So I like it by putting it on that way because you know what your downside risk is. It's the premium you put into the option market. That's all you're going to lose. And what is the upside? Well, an Armageddon scenario where you are in fact calling the price of the bond market correctly. My problem is what happens to the currency over that period of time. Yours is a 2024. Cool. Let's agree that for a 2024 position, my situation is not as concerning as a 30-year situation where you will see the combined impacts of a debasing currency over that time. So, Yuri and Timmer laid this out. I'm not sure. I think you don't agree with Luke Groman, but he lays it out as well. I sent the tweets to the fellas.
While you're talking, I'll find
Luke Groman, it's okay. Don't worry, because the point is this, guys. The net interest coverage of the USA right now is barely 1 times, which means at an average coupon of 1.5%, the US barely covers its interest expense. When the debt rolls over and it goes to 4%, well, you're not even close to covering your interest expense, and that's what the Congressional Budget Office is laying out.
So it ends with monetization, Greg. I mean, it's exactly what I wrote in the tweet. That's the monetization scenario. You're exactly right. If there's not a big enough buyer and the market can't withstand it and yields start to go higher, guess what? They're not going to stay there because they will step in and bid that. You said it yourself. I mean, we were in a clubhouse room over the summer and you said you expected above 3.5 on the 10-year treasury that yield curve control would start in the United States. Look at Japan. Right? Look at what Japan has done for decades now.
That's the only solution. That's basically the only solution. So then
which means yields going lower. Which means yields going lower. Which means if you're putting on this,
I guess I'll respectfully disagree. Why would they do it? I think they do it at like a 3.5%, which means that's where you're stuck. It means there's a unlimited bid there, but it also means that your fiat is sewering. Whether it's sewering against other fiats that are doing the same thing, no, it's a game of whack-a-mole. But it is sewering against hard assets like real estate, which you and I own. You don't like gold. I view gold as a better asset store of value than a lot of other things out there. So we can respectfully disagree on the outcome. I think, though,
how is gold a better store of value? How is gold, given the expansion of the money supply?
I don't want to talk. Sir, I don't want to talk about it. Only to say I view gold as being better right now than owning certain financial institutions. Is that fair? Like, I just don't.
We don't have to talk about it. I don't think that the data bears that out. But let's go back for a second. Let's go back to the depression-like scenario. In a depression, as you know, Greg, long end rates are driven by growth expectations. It is an essential feature of the long end. They're calculating the long-term growth protecting. Throw up the chart, for example, of the labor force labor force participation versus long end interest rates.
You're gonna have to tell me when here. Hold on.
It's a chart. This is probably the most important chart you could look at. I'll give you the title of it. 1 second here. Let's see.
Hey, well, while he's looking for that, I have a question for you guys about this whole rolling over the debt thing. So it is in my understanding, there's about $9 trillion that has to be rolled in the next year or so.
Yeah, 2 years.
So if we maintain these interest rates until that period of time, how do you guys see that playing out in the next year and a half?
Could I answer, Joe? Basically, you right now have an average funding rate. So the U.S. has about 450 billion is their annual interest expense right now on 30 trillion of debt, which means their average funding yield, their blended funding yield is 1.5%, right? Again, 450 billion divided by 30 trillion is 1.5% annualized.
Right.
That's
So is this going to
current budget? So then if you have to roll this debt at a 3%, let's say they roll it at a blended yield of 3% on 9 trillion. Well, let's just, to make the math easy, make 30 trillion times 3%. You're almost at a $1 trillion annual interest expense, at which point you're not even covering your interest expense 1/2 times.
Yeah.
Which means you have to issue more debt to cover that interest expense.
and that's
And if the only buyer of that debt is the U.S. Fed, then they do it by printing money.
Right.
But anyway, back to Joe's chart
This
here.
is the chart you're looking for, Joe?
Yeah, that's exactly it. This tells you the whole story. This shows you a path towards disinflation and deflation over the long run because of the declining productivity. The Fed has its biggest control over short end rates. The longer term rates are driven by debt, productivity, demographic issues, and what you see in the United States is deterioration in demographics, i.e., another way to say that is declining growth. And with declining growth come lower and lower long-term rates and yields. That is
But that's when your tax revenues, though, Joe, because your tax revenues aren't growing then, and then you, as a
Lynn
credit,
Alden,
you become a worse and worse credit.
Hold on. There is a historical precedent, and I know you know Lynn Alden's work. She frequently invokes the 40s, right, where you had the same debt to GDP levels or similar debt to GDP levels we have now. What happened out of the 1940s?
Except for a trade balance. Except for a trade balance. The U.S. was a net exporter, and now it's a net importer. That's the
correct,
difference.
which is going to make
100%.
it more right. Which
More
is
difficult. I beg your pardon?
That is going to put more pressure on policymakers to have to intervene. That's more. I mean, that's the argument. That's my essential argument, that you're going to have more intervention. You're going to have these rates be pegged or pushed lower.
I guess what it means then is more debasement. And I guess we will agree that means U.S. currency debasement leads to Bitcoin.
right.
And I what I would say, just let's be careful about all of the results in the last 40 years have been from financial crises that have started when interest rates were at 14%. And went all the way down U.S. 10-year under 60 basis points. I think you mentioned 40. I didn't realize they got that low, but even who cares? 60 basis points or 40 basis points is close enough to zero. The point is, even in the great financial crisis, there was room to move rates down.
Yeah, they're going to go negative.
Now
they'll go negative.
Well,
you'll have a negative 10-year, and the U.S. will follow the path of every other sovereign state.
Well, then the UK pension plans will blow up again because they'll have to lever their balance sheet to a negative gilt yield, which negative bond yields make no sense. They're no longer an asset. They become a liability.
They exist,
and there's everything on its ear.
There's trillions of dollars of negative yielding debt in the world. There's even more.
Not anymore. There was 19 trillion.
There's tens of trillions of dollars of negative real yielding debt. Okay,
real yielding, yeah. Real yielding.
Yeah.
So do you guys?
I'm with
get the?
So how do they?
Negative
so when you say
real
so when
yield.
I'm with adjusted for inflation.
I was talking nominal.
I understand. But what I'm saying is, when you say, "Oh, well, that won't work," it's working every day. Literally, institutions are making this work. Yeah. I mean, and you got.
Okay. That will make. Well, I'm not sure they're making it work. They've lost $15 trillion in value.
Right. Is there anybody not making
the
pension fund?
Market
has any pension fund missed a payment? Have they ever missed a payment?
Well, the UK would have if they didn't step in. That's why they stepped into the LDI situation. Well, I read different stuff. The US, again, I ran through it. The 30-year bond in the US, in the UK rather, the gilt had a 1.25 coupon issued at par. It is now trading, or was when it hit 5% yield. It was trading at 42 cents on the dollar, and they had levered it threefold. This was a disaster. These pension plans went unfunded. There is absolutely people who are opening up their statements saying, I thought I was in risk-free gilts. Well, they weren't risk-free. And by the way, they got levered 3 times because they tried to reach their bogey by using leverage in the pension plan to reach their hurdle rates. This is where things blow up, Joe. It blew up in the UK right now. That is why the Chancellor had to step in, the Bank of England, and say that they were a buyer of the long end. Everyone was a seller because they were getting margin called. You got to, that's well documented.
First of all, there's a lot of factors in play, and we can go into the UK situation. It's not merely the rates. It was the DXY pressure globally that is not driven by the Fed, but independent factors. And if you look at the main reason, Greg, and you saw the great British pound bounce on this news, is because they were foolhardy with how they rolled out their budget plan. They put out this budget, which I'm sure you're aware of, which showed a huge tax cut, and they didn't explain how they were going to pay for it. So market participants freaked out. They didn't have chance to respond quickly enough. So what does that do? It creates volatility. It creates a spike in yields. It doesn't necessarily mean doomsday or things are going to break or collapse. It means that the market wasn't prepared to respond. And that's the volatility.
Joe, it was a pension strategy called LDI, where they were using a dispersion index to try and manage leverage that really works well as long as rates aren't skyrocketing. And when rates skyrocketed, they all got their margin calls, and they were selling, invoked selling. And that's why the UK 30-year gilt went from 2% to 5% in the last 90 days. Yep. Historic. The bond price went, again, from par, 100 cents on the dollar, to down under 40 cents on the dollar in 30 days. Guys, do you not understand the magnitude of these price changes? Like, it's just ridiculous. And this was without leverage. Well, if you levered it 3 times, again, I'll walk you through the math, you lost more than 100% of that particular silo in your portfolio. Luckily, they weren't 100% invested in that strategy. But the crazy thing is, the UK was a much bigger player in the LDI space than the United States. There are pension plans in USA that do the same type of thing, including CalPERS, unfortunately, because they admitted they can't reach their bogey without using leverage in the pension plan. These are the dangers. You know what? The pound and the gilt market, obviously inextricably linked, interest rate parity. These are all the components. But the biggest thing was margin calls in pension plans, from my understanding.
Joe, do you have anything follow up there? And then I'm going to summarize.
No, I just direct everybody, and you can. I was trying to find the tweet, but you can look at Wei-Zin Bu, the Booth professor, and she shows the major stressors and the components, and you can break down the models. It shows that this narrative about the pensions is not the predominant factor. I'm not saying it's not a factor; it wasn't an issue, but you had significant currency stress that was driving that move, and the market doesn't like surprises. And the UK government totally botched this rollout with their budget. That's caused a ton of volatility and caught the market off guard. And the market doesn't like surprises. And when you see surprises in any market, it causes volatility. And when people are over levered, you're gonna get margin called. That's just basic market dynamics.
Well, the one thing I like. Sorry, go ahead, Dan.
I was gonna say, I'm going to pull up this tweet by Jesse Gilger. Hold on one second here. So here is his question for this conversation. How long do you expect to hold your respective positions? Time horizon is everything. When it comes to bonds, I have a feeling Joe is thinking in quarters and Foss is thinking in decades. It seems like so far in this conversation, on a decades-long time horizon, your two positions collide, or at least get very close to each other. Do you feel like this is an accurate representation of your positions? It seems like it is. It seems like most of this disagreement, as we suspected, is pretty time frame specific. This is just a kind of a summative statement of this section, but do you kind of both agree with that, or do either of you contest that summation?
No, I think that's a good breakdown, at least of my position. I mean, when we had the spike up to, I had already put on a good amount of my position even over the summer when we had the spike up to 3.5, and then we sold off, bonds were bought up pretty hard there. The 10-year caught a bid at 3.5. It wicked up there, and within, a few weeks, it was back down, I think, to 2.7, somewhere around there. So I already took off half my position then, and then as we went, parabolic effectively back up to 4, I kept adding the entire way, and I might add some more if we go to 4.5. I don't, I haven't thought about it. We'll see. To me, it is insurance, because I think 2023 can be a very brutal year. I think that all the signs are aligning that shows you the story is not inflation anymore. The story is slowing growth. I mean, look at today. You had a 10% increase in job openings. Okay, decrease. 10% decrease in job openings. You had 1 million job openings get cut. You've got all the signs of deflation and disinflation across the board. So you want to be prepared for that environment. And to me, real estate, stocks, Bitcoin, I love them all, right? They're the core of my portfolio, but I don't think they're going to all take a hit, and everybody should be prepared for them to take a hit in a deleveraging event.
Yeah. And I guess another statement I want to make, not to undercut your position at all, Joe, but you started off explaining the magnitude of your Bitcoin position percentage-wise in your portfolio, and then saying your long dated treasury options position is like 4%. So obviously we're not talking 30% of your portfolio here. We're talking a small subset hedge position. And then Greg has none. So I don't know, I think that there's something to bear there in terms of where the tokens actually are on the table. The one thing I want to get to before we get off this, and we want to get to Bitcoin.
Dan, one thing, and this, maybe Greg can answer this, okay? And it'd be interesting for the viewers because we want to make this practical. If you're headed into an economic hurricane, which I've heard Greg say that he expects things can deteriorate and we can have a credit issue, just tell what you think, without giving financial advice, what you think is a good hedge to Bitcoin. Because as I hear it, you tell people that 95% of your money should be in something other than Bitcoin. What is a good hedge to your Bitcoin position?
Let's be careful. Yeah. Okay. The reality is I'm trying to talk to big money. Okay. I know that most of my followers are obviously people who are individual investors, and I'm very humbled by that. But when I wrote this paper, I wrote it for big asset managers, guys that will never take a position even larger than 10% of a portfolio, okay, in any single a security or even a basket of securities, okay? For them to get up to 20% exposure to private equity, for example, took almost a decade. And so when I talk about 2 to 5% exposures, I'm trying to talk mostly to big asset managers, guys who I've traded with my entire life, that obviously for them to get a 2% exposure, though, we're talking trillions of dollars that would flow into this asset class. So to answer your question, though, and I agree it's not happening yet, but I do have enough experience in the high yield debt market to know that slowly then suddenly, as long as Fidelity's doing it, BlackRock has to do it because they have clients who are demanding that they do it. When I say they do it, BlackRock, or else they'll take their business to Fidelity. It was the same thing in the high yield bond market. It's the same thing for any emerging asset. They have to get comfortable with it. They have to see their competitors doing it because largely they are theory of agents. As long as everybody loses money the same way, everyone's fine with that, right, Joe? Oh, OMERS, a big Canadian pension plan, lost money, but the same thing happened to the equivalent fund in Quebec, and so everybody's fine with that. That makes no sense from
safety
a risk
and
management
numbers.
for me.
Safety and numbers.
Okay, so correct. But here you say, my hedge is actually Bitcoin, so I don't hedge my hedge. And this is the way I'm trying to explain it to other larger asset managers, whereas you have an exposure that I told you I couldn't sleep at night with that big of an exposure in an asset that you have given back. I'm sure they were gains at one point. You said it yourself, a meaningful size, more money than most people ever get in their lives. And that's just the difference between family offices and high net worth individuals and big pension plans versus the average mom and pop investor who largely have their exposure to these assets through their pension funds. So I'm trying to talk to the pension funds. If you on a Spaces, there's a guy by the name of Worth. He's a Southern United States, used to manage big money, ex-hedge fund guy, agrees with my approach because he's the same way. He managed money for large institutions and family offices where you can't go to them and say, my exposure is 65% to this emerging asset class. They would fire you on the spot.
Of course not.
They didn't want to make money.
But Greg, that's not what I'm talking about.
It's the money I'm talking to. I'm trying to talk to that money.
This is the blue collar
Bitcoin.
Bitcoin.
When I say 5%.
Yeah, wait. Hold on one second.
Okay.
So I want to say this because I do want to end this bond section, and then we do want to get to Bitcoin before we close this out. Because we got to make this digestible for the average Jill and Joe.
Yeah, that's what I'm saying. This is blue collar Bitcoin.
For
$20,000 net worth. What are you telling that guy to do? 100% Bitcoin?
This is the scenario. This is the scenario I want to hear.
Me?
The person I want to hear you both comment on before we get off this. The average Jill and Joe who is in the Vanguard, who's nearing retirement or whatever, that they're in the Vanguard 2030 or the Vanguard 2025, and they're in their 403B or their 401k or their 457, right? And they don't even know what that means. They have significant exposure to a total bond market index, right? What's your thought for that person? Because this topic, although this may be common speak for people that speak financialese, this is esoteric for the average person, right? So for your person that's passively investing, signing up with whatever their Fidelity or Vanguard account recommends, what is your thought for that person on that level of exposure to fixed income?
I'll just go very briefly. Okay. So again, none of this is financial advice. You should consult with somebody who's registered, blah, 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 legalese, all that nonsense. I'm just telling you hypothetically, okay, in my personal opinion, if I had money trapped in those sort of accounts that you were outlining, those sort of retirement accounts, I personally would have an asset blend that does not have a huge concentration of bonds. And in this environment we're in right now, and this is a legal requirement, every one of those funds you just named have to give their participants a option to get into bills, right? To get into some sort of short-term treasury paper. That is your hedge in this environment. That will give you an ability to buy the dip if there is some sort of deleveraging event. Now, if you've got money that's outside of those accounts, it's totally different, right? If you've got, liquid assets that you can invest, you should be reasonable. You should do a Bitcoin allocation that, like Greg said, I agree. It lets you sleep at night. You're not overexposed. You'll be okay, and you'll have money set aside, dry powder if Bitcoin does. If you get the opportunity of a generation to buy Bitcoin lower than where it is right now. But the question I was trying to get at, Greg, and he can answer it when he responds here, is that, there's, aside from the bigger players you're talking to, you've got 111,000 followers. And those folks, I know a lot of them are overexposed to Bitcoin. I talk to them. I talk to people that have higher allocations than me. Our buddy Bitcoin Tina, right? He had a massive Bitcoin allocation, right? He sold down to the sleeping number. There's nothing wrong from that. He was chastised by it, by the group, by the crowd, right? They maybe he was overexposed, never should have put that position on to begin with. That wasn't proper risk management. I'm sure you can agree with all that. But he still has a massive chunk of Bitcoin, right? And he has dry powder in the event of some sort of, hard landing next year to buy the dip. And he intends to do that if you talk to him. So other people out there, I question if they're prepared for that event. And I want people to be prepared. That's the only message. That's the only disagreement we may have. But I don't know.
Joe, when you say prepared, I guess this isn't financial advice, and we've said that a million times, but
I don't want people jumping off buildings.
Right.
Bitcoin's at 5K next year.
I don't want to see that happen either.
It's that simple.
It's a potential for a lot of people. A lot of people think
we'll
they
be
can
the one
handle
going
this
to
shit.
get them. Yeah, don't do that.
Yeah, I've seen enough people do that. The point I'm trying to get at is, so for the average Joe, I'm not going to jump in the options market and play around with that shit, because I have some basic understanding, but I know myself well enough to know that I don't know it well enough. So I sit on a bit of cash, and if this happens,
there you go.
Save 10-15% of my portfolio is cash. Is that,
yes.
I mean, that's a number that I'm pretty comfortable with, that I have an opportunity cost I potentially miss out on. But again, I have some dry powder for this potentiality if it does come to pass. And if it doesn't, I wasted maybe a year sitting on it.
If it doesn't, your Bitcoin will appreciate. Right?
Exactly.
So you're happy.
Correct. Now, guys, let's focus on what Joe said. I agree with everything he said, and I just want to make sure I am not embellishing what he said. If they own too many bonds, he wouldn't buy more, I think, is what you said. I think you feel that there's too many people out there that still own too many bonds. Did I misinterpret what you said?
No, you're exactly right.
Okay. So again, yours is an insurance position. It's almost a upside down trade, I would call it. You are upside down on your trade to hedge a Bitcoin exposure that I prefer not to take as big a Bitcoin exposure, but I have therefore zero exposure in bonds, because we're talking the same language there. I
have a job. I'm working, unfortunately,
Yeah.
That's the thing.
Yeah, and that is something I wanted to highlight.
Cool.
You two, the two of you, you're both successful in your spheres. You're at different stages in your career. You're going to have different allocation sizes. You know what I mean?
Right.
Greg, you had an incredibly
Guys,
successful career. You're phasing out, Joe, you're in the middle of your career. Your cash flow is flush and probably going to increase. You know what I mean?
If I may just finish, okay, because this is key. Bonds still don't offer the upside return potential that I'm looking for an outright investment. If it's a hedge in an Armageddon scenario that Joe's talking about, man, there's going to be a lot of pain in every asset class. I'll agree with that. My biggest hope, and it is still hope, that there's a decoupling where people do the math and realize that Bitcoin actually is an anti-fiat. And maybe this is a good segue for the next conversation on Bitcoin if you want to take it there.
Yeah.
But I'm going to still go on Joe and rely on what Joe said, because it's my feeling as well. I would not be increasing bond exposure here if you have a 60-40 portfolio, 60% equities, 40% bonds. Just because bonds are now cheaper than they have been and finally got to a yield where there is a semblance of a return that's greater than 1.5% annualized, it's not enough for me. Because the last time CPI was at this level, 8%, was when I was started trading in the 1980s, and guess where interest rates were, okay? They were double digits. This is the difference between then and now. And a 3% yield, 3.63% yield, when CPI is still 8%, that doesn't cut it by me. I need to see the information change and see this deflationary environment come to fruition before I get bullish on bonds. I think Joe and I are saying exactly the same thing. Fair enough?
Yeah, I wanted to chime in on the Tina thing. We love Tina, and it's hilarious to watch people pile on him. You got people living in their parents' basement, ripping Tina. He's probably got literally 500,000 times more
Tina
Bitcoin. The point is, though, if you have 100% Bitcoin without very strong and incredibly reliable cash flow, you have the potential to get fucking wrecked. And people need to be careful. We're as
100%.
bullish on Bitcoin as anyone in the world, right?
Tina was very belligerent for other people that were selling their Bitcoin at higher prices. That's what his biggest, the biggest comeback on him was. That's fine. I think that he's a big boy, and to his credit, he didn't escape from the space. He didn't give up his name.
He has the humility to be honest, too.
Tina.
He made a mistake, Greg.
That is fine.
He made a mistake.
And
everybody makes mistakes. I
mean, I doesn't have to say that.
If I have made, if I out of 10 trades, I make at least 4 mistakes. Okay, probably close to 5. The difference is managing your mistakes and letting your winners ride, where most people sell their winners and keep their losers and compound their mistakes. At least Tina saw the information change, saw his chemical makeup changing, where he couldn't sleep at night. He had a fiduciary responsibility to his family not to lose all his wealth in an asset class that we've seen. It feels so good when it's going up, but man, oh man, does it ever leave marks when it goes down, right? So Hats off to Tina. Hats off to people who change their portfolio when the information changes. The people that don't change their portfolio when the information changes, they call themselves Peter Schiff, and they keep beating a drum. Oh, look, it went from 70,000 down to 20,000. See, I was right. No, Shifty Pete. You said to people, never buy it at $10 a Bitcoin. That is the problem. So let's give a credit to Tina. Let's agree that Joe and I largely have the same view on bonds. The funny thing is, Joe, that you're so adamant about a position that's just only 4% of your portfolio. You could throw it back at me and say, Foss, you're so adamant about a position in Bitcoin that you're only advocating 4% of your portfolio or 5% of people's portfolio. The difference is most of the people I'm talking to, Joe, have zero exposure. Not the followers on Twitter, obviously. The people I hope to get into their mind brain. Like the
I know, Greg, but here's the thing, and this just comes from a difference of opinion. I know, I'm attorneys for people with big money that are putting money in the Bitcoin space, companies, institutions, funds, etc., that have put big. But here's what I'm concerned about. At the end of the day, they've got a lot of money, they've got a lot of capital, and sure, their P&Ls may take a hit. They may have a rough year investing wise. But I know other people that literally took out student loan money last year and in 2020 to buy Bitcoin.
Absolutely
and
wrong.
They're going to get
absolutely wrong.
I worry for those people. Okay. So when you talk about my emphasis on it, the reason I'm emphasizing this, and we're on the Blue Collar Bitcoin podcast, is because I know a guy who's a laborer. Okay. One of my good friends. and he says my entire net worth's in Bitcoin and it's only $20,000. And that really scares the hell out of me. And I'm worried about that.
Who gave him that advice, though? Was he able to do
Not
it
me.
himself? Or because I don't, you know that I've never publicly allocated more than 5%.
I'm not, this is not about you.
More myself.
This is not about you.
I'm just saying, but so here's the crazy thing. Like, but here, I'll play a flip side of if you've only got 20,000, Joe, you don't have enough money anyway. You might as well put it all on black. This is not what I'm advocating, but there's people that live like that, right? And you're never going to get that out of their system. I think it's ridiculous. I don't do it myself, but these people that do say that they're 100% exposed to Bitcoin, I never want to ask them what their true exposure is in dollar terms, nor is it my business. But my thought process would be they're putting it all on black. And I actually believe it's a better than 50-50 chance, all on black versus all on red. I think it's better than 50-50 chance that it's actually a good long-term trade in Bitcoin. The difference is the market's telling me I'm wrong right now. And the most important thing is they don't know how to manage risk if it does come to fruition. What they'll probably do is not even sell any. When it reaches a price that they need to be taking chips off the table,
they won't.
They'll be saying, no, I'm going to let it ride. I'm going to let it ride. I'm going to let it
They
ride.
won't even, you know what they'll do? They'll do what certain people that will be not named told them to do last year, which is to take out loans on their house and buy Bitcoin with it and get leverage to buy Bitcoin, which I think is completely ridiculous and not responsible in any way.
Well,
and we don't speak up enough about that. And I'm trying to sound the alarm here, not to be somebody that's the sky's falling, but be responsible. We're heading into a very challenging economic environment. I know you realize that. It's not all rosy. There are storm clouds on the horizon.
I've never been more scared. This is the most scared I've been managing money, even though it's only my own right now, than I have been since 2007, right before the subprime mortgage crash, okay? The credit markets were flashing all sorts of orange and red, and the equity markets were whistling by the graveyard. Now, the equity markets have largely caught up this time. The difference is the potential leg down is not protected because right now it's the Fed fighting interest or rising interest rates into a recession. So there's no buffer. There is no flight to quality or flight to safety rather, because that position is also down double digits this year in the form of bonds. I hope there is no Armageddon scenario, Joe. I really do. You've heard me say that. We're not ready. The world's not ready. We need to help develop this parallel network so that ultimately, as you say, it dies a slow death, or even better, it doesn't die a death. Fiat money is good for global trade. It's just not good for a store of value. And you have a parallel network that is your savings account called Bitcoin, and you have your checking account, which is fiat money. And therefore, you have still healthy global international trade. That's my view. It's a network transfer that is orderly over a period of time, not driven by a financial calamity orchestrated by the Fed. If I may, the last time you and I talked, you were not quite as negative on the economy. Is that fair? You were sort of more bullish on the economy.
I'm negative on next year. In this entire year, you've got nothing but people saying the collapse is here, the collapse is here. You're clipping along at 2.4% real GDP per Atlanta Fed now. You've got a labor market that's historically tight. I think the conditions for a recession have been set already for next year. The Fed, if you listen to the Fed's rhetoric, they have all but abandoned the softish landing. Now what they say is they use language, which is really telling in Fed speak. They say we're on a narrow path to a softish landing, right? Which is basically a concession. Look at the summary of economic projections. The summary of economic projections that they put out basically says growth next year on a real basis is going to be 0.0. That is the closest you're going to get to an admission that there's a recession next year.
Okay, fair enough. And here's the chance. What's the chance of that coming true? Look at yesterday's ISM manufacturing for manufacturing. ISM for manufacturing. Yesterday, employment was under 50. Okay, that shows manufacturing employment contraction. These are some of the reasons that I think that the Fed does not get to its 4.5% target from its current level of 3.25%. we could talk about what defines a pivot and everything like that. The market is just looking for some sort of indication that the Fed is taking their foot off of the accelerator in terms of these interest rate increases. You'll see the Dixie come off. You've already seen it come off a little bit. All of this leads to the potential, in my opinion, the potential, Joe, that 0.0 comes to fruition. My biggest concern is it's too late, and already there's too much pressure on housing prices in the UK. 30% of the housing market is got variable rate mortgages. Housing prices are collapsing. Net worth of families is collapsing. Who knows what happens? But I am never been more scared in terms of the potential breakup in the system right now.
Here's where you should be prepared, right here. Here's where you should be prepared, because the market, in my opinion, and this is why I've been pounding the table on this, you will see signs of disinflation. You'll see CPI start to decline. That's not to be celebrated. You'll see rates, particularly at the long end, you'll see those start to come down. That's not to be celebrated. That tells you that there's dark clouds on the horizon. And that's why I'm looking at the bond market, because I think the bond market's going to sniff out these disinflationary forces before any other market. Everything else, the stock market, Bitcoin, they're all derivatives of the credit market. They're all derivatives.
So you think we're going to invert significantly or more so pre-recession?
Well, the 10 and 2s have been inverted, the whole summer effectively, right? And the key thing, I was looking really closely. All the original research looks at the 10-year and the 3-month. That is not yet still inverted. I think it does invert probably after the next hike. I think Fed funds will invert the 10-year. I expect that to happen later in this year. Fed funds will invert. I think we're at like 100 bip spread at this point. You'll get that. So you'll see warning signs. Greg's right. I've been surprised at how well the economy has actually held up this year. I think that most people would. Luke Roman, we talked about him earlier. He said the Fed was going to do one hike and be done. And then he revised it and said they were going to finish hikes in September. They still have shown no indication whatsoever they're going to slow down. Nothing.
All right, let's pivot to Bitcoin.
Yeah, let's talk about how this is going to. No, sorry, Greg. Let's talk really quick about how this is going to affect Bitcoin. And assuming you were right, Joe, and you guys seem to both agree that there's storm clouds on the horizon for next year, where there's very likely to be a severe recession. Bitcoin is very likely to get absolutely decimated in that. It's hard to say what kind of number it would be, but it's probably going to be significantly lower than where we're at now if that does come to fruition. How are you guys approaching that situation? Are you just looking to have dry powder available to keep dollar cost averaging on the lows here? And then what would be your suspected turnaround time? Do you think this will keep moving along this 4-year cycle the way we've seen in the past? Or do you think these macroeconomic wins are going to be enough to change that entire trajectory for Bitcoin?
So can I go first, Joe? Just so that, yeah, thanks. So here's the thing. The Bitcoin market, in my opinion, has weathered some already severe storms just within the digital asset ecosystem that was quite impressive. Okay, in the absence of concern about what the Fed was doing, this UST Terra, US Luna, US Terra collapse was just an absolute shambles. The Celsius and all the over leveraging within the digital assets ecosystem. TikTok next block, the price came down from 70,000. There's no question it would never have gotten up to 70,000 if it wasn't for the Luna Terra buying. And then when they had to unravel that whole thing, it got down to around 30,000, and there was a lot of pain in the markets. But I was impressed with the resiliency of the bid and the ability for the markets to work their own problems out without a backstop. Okay, that is a mark of a maturing asset class. I still have a belief that because of the decimation in bonds as well as equities this last 6 months, there are institutions that are doing their homework. There are countries that are doing their homework to get a larger allocation to Bitcoin. Whether or not I'm right will play out over a period of how bad the decimation in the other assets are. But I'm not smart enough to tell you whether Bitcoin should trade at 20,000 or 10,000 right now. And quite honestly, I don't care. I'm set up for a different type of trade as I try to lay out over a 20-year time frame for this asset class, not for bonds, because it's only 14 years old, coming up just on 14 years old. And there's no way you can make these decisions based on historical data. They don't exist.
Yeah.
So you have to You have to plan for both outcomes, fellas. And that's why I'm not 100% exposed. And that's why I have taken profits, because I also bought in at a price of $1,000. Well, the truth is this: Bitcoin's a better risk asset right now, risk return opportunity right now than it was at $1,000 in 2016. Why? Because we've seen the response due to COVID. And we've seen the debt and the global money printing, $9 trillion of global money printing that has impacts. Joe said it's not a CPI hedge, and that's correct. What Bitcoin is a monetary inflation hedge.
Right.
Monetary inflation is required to solve this debt spiral, pure and simple. Go ahead, guys. I finished.
I just want to make one comment. We've spent some time here the last few minutes talking about the potential likelihood that price goes down. All four of us agree this asset is insanely unique. It's marvelous. It's got a plethora of use cases and value propositions, and it doesn't take very many large buyers for there to be a significant risk of sitting on the sideline. So I think we would all agree that too, that this thing has the potential at some point in the future, whether that's tomorrow or 12 years from now, to go in a direction to the upside that could really surprise. So there is a risk on the other side of sitting on the sideline.
Always.
You need to get a seat in the chairs before the music stops.
Right, Dan, and I don't know if you've listened to the last podcast, The Hardest Trade 2 with Tina that I did, but I've thought about this since 2015 when I started buying Bitcoin, that, you know, my view is I want to be able to go to bed at night, put my head against the pillow, and be prepared to wake up tomorrow and Bitcoin to be $500,000 and it'll be great. It'll be wonderful. You know, hopefully that's a good place the world's in as well. Or I want to be able to go to bed and wake up tomorrow and Bitcoin to be $5,000 and I'm not going to want to jump off a building. Either one, I'm prepared for the eventuality. But let me go back to where this all goes. And I think that the most challenging aspect of this environment, as Stanley Druckenmiller said, is that you've never had these sort of inflationary CPI dynamics that we're currently struggling with. Even the 1970s is not really a good analog because of issues with the labor market and debt levels are totally different. So to me, in the next 3 to 5 years, the prospect of Bitcoin and its price appreciation, in my mind, is contingent on the Fed being able to get back to the business and central bankers getting back to their regular and orderly course of business, which is debasement, which is fiscal stimulus, which is having to drive forward and pull forward growth. Because if they can't, and you're headed for structurally higher inflation, and I'm not talking about 3%, maybe it runs a little bit over the last 10 years at 2%, maybe you're running 3%, that's fine. They can deal with that. They can debase, they can print, they can stimulate, they can do UBI, they can do all these things. But if you're running at 6.5% or 7%, those elevated numbers, I think every asset takes it on the teeth. And I think that the risk premium of all these assets changes when you can go get treasury paper north of 5 or 6%. So I hope, and it's more of a hope than anything else, I hope these rates come back down, because if they don't, the whole game's different. And Greg knows this. The risk premium for the stock market is historically overvalued if you're going to have treasury paper north of 5%. It just is. Just the reality.
Oh, yeah.
And I agree 100%.
So it's kind of two paths. Either you have a reversion to the mean and you have these rates come down, and I expect Bitcoin to do wildly well because that lets the central bankers and other fiscal authorities go back to their old tricks and develop all new ways to pull forward consumption and deficit spending, and et cetera. Or if you're in an inflationary decade that's really uncontrollable and resource shortages, it's going to be rough for any investor. I mean, Druckenmiller, again, I'll reference him. He just said that he thinks the return for stocks could be pathetic for the next 10 years.
I agree. He said, I shouldn't say I agree. I agree. I heard him say that. I also agree. I heard him focus on the U.S. debt spiral that said, Joe Kernan, the co-host of CNBC, said, well, we'll all be dead. And that was a sort of laughter. And like, that is an irresponsible answer. Okay, well, then we don't have to worry about it. Our kids have to worry about it. And that's what makes me sick. And I think you would agree with that, Joe, is that we're leaving a debt burden to our children that is absolutely mathematically impossible to solve, with the exception of Luke Groman's out, which is yield curve control and inflation of the tax base, the growth of GDP because of inflation. It's painful for a lot of assets. All paths lead to Bitcoin. If I can, one thing, you know what, you and I don't agree on my evaluation of Bitcoin as an insurance using CDS on the USA. That's cool. I just want to call out people that have given me, I love this type of analysis, including a tweet I sent to you guys, Dan and Josh, of that guy who admitted he was a math nerd, and he also admitted he hated Bitcoin. Even though he owned it for its asymmetry to the upside, he goes, I love this analysis using credit default swap spreads to give an intrinsic value of Bitcoin. Now, I'm proud of that, Joe. I don't ask you to agree with it. I'm just proud that I get people like Robert Breedlove and Dr. Jeff, who come out and say, hey, this is another valuation model in the ability to put an intrinsic value on Bitcoin.
But how do you even unpack that, Greg? Greg, hang on a second. Let's just you take the market cap of an asset and you say that this will pay off. I mean, you know CDS, you know how CDS works. It works in the event of a triggering event, an event of a default, it's going to pay out. What is your baseline assumption that in the event of the US or any other sovereign defaulting, they're going to rush towards Bitcoin in that sort of doomsday scenario? What evidence is there of that?
What other choice? Well, there isn't any except where else would you go when all fiats are breaking down?
Apple computer, like Apple stock. I mean, Apple has a market. Imagine your analysis.
Fair. It's a harder asset than a bond, so I would agree with that, and that's something that Santiago, Brett Johnson agrees with as well. He thinks that blue chip equities will be the next recipient of a lot of this. I am not going to say that I'm 100% certain of it, Joe, and this is the key. But I'm more certain than 1%, which is essentially the odds the market's giving me. And that's how I manage risk, okay? I like to say, what is an expected value distribution of outcomes? I think Bitcoin is one of the recipients of this flow away from the traditional assets that aren't working in that type of outcome. So all I would say is this: Fidelity has a model that thinks Bitcoin gets to $1 million US per Bitcoin using an adoption model that they compared it to cell phones and to the internet. I'm sure you guys have seen that, right? It's pretty good research. And they come to a US $1 million price for Bitcoin by 2030. Then we had the infamous Plan B, debunked potentially or whatever, but it was a model that was embraced at one point. I'm not saying my model's the be all and end all. I'm just trying to get it how I think about it, Joe, into the minds of others.
Greg, you don't know the denominator. You don't know the denominator, which is the growth of the money supply. You don't know it. I mean, if you're going to do any of these models, I don't care. They're all in my opinion.
Well, I can use it in today's dollars. I see it in today's dollars.
Which tell you nothing.
Right? That's what I'm basing it on in today's dollars. The U.S. debt. No, the U.S. debt today, I base it on U.S. debt of a close to 200 trillion total funded plus unfunded debt in the USA.
Structurally, this is just an honest disagreement, and I respect your opinion. I don't think it makes sense because the debt markets, when you liquidate those bonds, okay, those treasury bonds, somebody gets cash, and who gets the bonds? Who holds the bonds? Who holds them?
I guess the buyer.
Right.
Or the buyer.
The buyer holds the bonds, whoever bought it, whether it's a central bank or another. The cash doesn't. For every buyer, there's a seller, right? We can agree in basic market. So to take the debt market and to say this just flows into when there are structural and legal reasons why that cannot occur.
No, but I'm using
occur.
No, I'm not saying it flows there. I'm saying you're taking an insurance premium that's calculated in open market daily price movements from buyers and sellers of default protection. I'm taking that rate and I'm applying it as a percentage of the outstanding debt burden of the United States in today's dollars.
The problem is you could take that and apply it to Ethereum. And none of us think Ethereum is going to be CDS for sovereigns defaulting, right? You could take the market cap of Ethereum and say...
Ethereum is fiat. This is based on the fact that Bitcoin is the anti-fiat. That's the key. If you don't agree with that, then I'll...
But the majority of the world does not agree with that right now. That's the problem. The majority,
because they haven't done the work that perhaps you and I have done, and you disagree that it's anti-fiat, but I
no, I don't
absolutely think of
hold
Bitcoin
on.
as-
No, that's not fair. I don't disagree. It's anti-fiat. I
Okay,
disagree. I
okay.
disagree that I think it's a false assumption to tell people right now in the market if the U.S. defaults, and you put again, this goes back to people saying, "Oh, it's a hedge against CPI." If the U.S. were to default again tomorrow, to suggest to people that that would pay off and be insurance for Bitcoin, I'd think you'd see Bitcoin at $1,000 a coin in that environment if the U.S. is defaulting tomorrow. I think you'd see Bitcoin.
I'm not trying to say that.
And
I'm trying to give it an intrinsic value. I guess here's the thing. I don't expect the U.S. to default, but
I
there
don't either.
is at least a premium that's being paid by people in the market that want that protection. That's the beauty of an open market insurance premium called CDS. Now, why does it trade there? Largely because Italy trades a lot wider, largely because Canada trades a lot wider, and there's a correlation impact, a contagion impact amongst the sovereign debt of the world.
But Greg, do you think just to put a cap on this? Do you think big money, big institutions that they go and put on risk and put on you call it an asymmetric risk reward, the best one you've ever seen? Do you think they go to the market and they say we're going to put chips on something that has never happened before, and that would be a doomsday scenario, which is the U.S. default? Do you think that's a persuasive? I mean, I was talking to Bitcoin
again. I guess I try to sorry to jump on you, but it's not Bitcoin defaulting. Excuse me, USA defaulting. It's actually the 180 fiats, the money that's managed in these other countries that need it more than the USA. Now, this is the key, right?
But your calculation is using U.S. CDSs. Your calculations
if you read the tweet, it said you're paying this on the USA and you're getting all other fiats for free. It was my way of trying to simplify rather than saying, let's add up all the other fiats and get an intrinsic value and forget about the USA. I'm just saying there's a market out there for the USA, and both of us agree that it's de minimis, but on $200 trillion worth of debt. So the point is this: I don't do it on the USA as much as saying, guys, you're getting it on all other countries in the world for free. My God, it's so beautiful. Anyway, guys, it's late. I will tell you one thing, and I'm going to give the last word to Joe. He's been a true gentleman in this conversation. I respect all of everybody's view. That's what makes a market, right? We have to sit and understand that markets are made of a buyer or seller. The echo chamber of the Bitcoin community sometimes gets overwhelming. I'll agree with that.
Yes.
Joe and I have had our differences. But I respect the fact that he came on here as a gentleman. I want to thank you, Joe. I want to thank you, Blue Collar Bitcoiners, for putting this on. If anybody learned anything, I'm confident I learned Joe's position better. He's smart doing it in the options market on bonds. The funny thing is, we're inverted. His trade in bonds is my trade in Bitcoin, essentially, and we're trying to accomplish the same thing because his weighting in Bitcoin is too high for me. I can't get to that level, so I'm doing it in a different way. Hats off to everybody who manages risk properly, okay? Don't put all your eggs in one basket. Do the math. Extend your time frame, most importantly. This debt spiral cannot continue. That I know for sure. When it ends, give a target, but never a time, right, Joe? Give a target, but never a time. That's the best way to manage money. They can't pin you down by saying, okay, well, you said your target was this. And I said, yeah, it's still my target. I never said when it was going to get there. This is the key. We are living in the next 90 days, I think is going to be crucial, absolutely crucial to a viewpoint as to where the world will be for the next decade. If the U.S. does not give in, if they stick to their guns and Powell sticks to his guns and raises Fed funds to 4.5%, another 125 basis points, I don't even want to think of the calamity that the world's in at that point. No asset is safe. That is true. I'm still holding my viewpoint that there are smart enough people, including the fact that the UN is now trying to get the Fed to change policy. I've never seen this. Never would I have ever thought that the UN, United Nations, would weigh in on Fed policy. But that's the world we live in. Last word to Joe, Josh, and Dan. Thank you again. I know for sure I should never have muted my friend Joe. I'm going to unmute you, sir. And when I did block you, that was truly a fat finger. Okay, yeah. Please believe me when I did block Tina. I absolutely 100% blocked Tina because he and I actually went on text, back channels, we'll call it. But I did not mean
diplomacy
to block
behind the
you.
scenes.
I meant to mute you.
Yeah,
I meant to mute you. So I'm going to unmute you, and I don't give a shit what other people think of me. I will always tell the truth as I see it. And I think you're the same person, Joe. And all we can do is tell the truth. There's not enough people telling the truth out there right now. This is a risky world we're living in. It has gotten us here by fiscal and monetary mismanagement. Hedge yourself against the Fed clown car. That's my best advice. Thank you, guys.
Oh, I'll just say I appreciate it, Greg, and I don't ever take an honest disagreement personally. I value your opinion. Even if we disagree, I think it's important to have healthy disagreement in the space, and absolutely, and we have to have these discussions. That's key. That's key. So I appreciate you. I value your scholarship and your contribution to Bitcoin. I don't mean to undermine any of that. And there's nothing wrong with an honest disagreement. As you say, that makes a market. I will just conclude in terms of my framework of how I talk to a lot of, I was going to get into this earlier. I've talked to Fortune 50 companies about Bitcoin. Okay. I've tried to explain it to them in a very basic way. And I've tried to, they've told me a lot of things and great insight about structural issues to them entering the market. Things like they can't liquidate $100 million positions. Big insurers can't do that on a quick basis. That's a problem. We need to get this thing bigger. We need to get this thing in the multi-trillions of dollars so that can provide that liquidity in a crisis. And I think Greg understands and agrees on that. My only thing is this. Okay. I think there's a pervasive attitude, and this is not Greg at all, because he didn't come through on this. He agrees, we need to kick the can down the road as long as possible to try to sustain this system so that we can have a smooth and orderly transition to Bitcoin. That's my hope too. But I think when we go out there and we talk about Bitcoin, and you guys, you do the best. I mean, you talked people at the firehouse, right? You're a regular guy. I don't think it's effective to go out and say that Bitcoin is, it's going to help you in a doomsday scenario. I don't think people think about that. They're thinking about their kids. They're thinking about their family, church, extracurriculars. They're thinking about how do I have a decent retirement, basic things. They don't like to think about the end of the world. Greg and I can think about the end of the world, and we can go back onto our jobs and try to make money and do whatever else we need to do. But my point is that our messaging about this cannot be, in my opinion, respectfully, I don't think it should be like this is your protection against a calamity. I think you should look at this as saying the world is really messed up. We have a fundamentally broken system, and it could drag on and die with a whimper, and all roads lead to Bitcoin, as Greg says. But that can take a long time. It can take 10, 20 years from now, right? That's it. So I appreciate Greg coming on and talking. I appreciate our daily chats on Twitter Spaces, wherever as heated as they may become. And I will tell you, I don't take it personally. I don't take any disagreement someone has on a genuine basis personally, even if I strongly do. And, it's okay. We're adults, right? We can curse back and forth with each other and then go have a beer. That's how things work, right? This is not, a safe space on Bitcoin Twitter, and I don't expect it to be.
Yeah.
Yeah, we were insanely light profanity tonight.
We were. Almost. It's kind of disappointing, Dan.
Yeah, it is.
No, but
my
dude,
2 highlights are done, so we need to get our cue right there.
We greatly appreciate the two of you guys. Both of your insights are really helpful for the two of us, I know, and I think probably for all the people listening as well. And thank you guys for both being very courteous and professional to each other, not, swinging. Not sure exactly how far away the two of you guys are, but long, way too far for a fist. But maybe we can get that together sometime
Even
too.
like a hockey fight, though, guys. Even like a hockey fight, we would have gone out for a beer afterwards.
Yeah, I mean,
right?
this is reminiscent of a firehouse dinner chat. Guys at each other's throats, but when those tones drop and we head out on the street, we're all on the same team, man. And Joe, I couldn't agree more, and I know you view it this way too, Greg. You've got to escape your cacophony, your filter bubble, and the groupthink. You have to have people, you have to be seeking out perspectives different than yours, and you have to keep people in your inner circle that disagree with you. If you have nobody close to you, nobody that you love and care for, that see things differently, you're on the road to cultism, man. And so, yeah, we appreciate it. We got to create environments where people can sharpen knives together. So thanks, boys.
Thanks, guys.
Awesome. Thank you, guys.
Appreciate it. We'll have you guys
Thank
on
you very
again.
much, fellas. Have a great night. Thank you very much, everyone.
Take care, Greg. Take care, Josh and Dan.
See you, Joe.